Now it's time to bring in our first guest of the hour, Howard Davidowitz of Davidowitz Associates. He is an expert in the world of real estate, the chairman of Davidowitz Associates. And Howard, good to have you with us on Surveillance Midday.
Thanks for the invitation.
Now, Howard, how long have you been watching the retail world? How long is your career span? So you got a real perspective.
Well, we've been at this more than 40 years. I've been in my own business for more than 30 years. I worked in the retail business. We've been investing in it a very long time, advising clients a long time, doing investment banking a long. We've been at this a long time.
And you were telling me just before we came on that indeed one of your first jobs was you didn't even get paid for it. You were a truck helper. You were unloading trucks and you got paid whatever the tips were.
Oh, tips, and that was a pretty good job because I made more than my friends who made minimum wage. So I did all right.
All right. Now, what about the consumer right now? Because a lot of people not doing all right, a lot of people doing all right. It seems we've got a tale of two economies. What's your outlook for the consumer right now?
Well, I think if you look at the overall consumer, with unemployment in terrible shape, 17.5% underemployment and unemployment, 46 million people on food stamps, housing is going to continue to go down. And if it goes down another 10%, we may have a double dip because 10%, I think, puts us over the edge, another 10 in housing. I would say the consumer is in pretty terrible shape, even though capital markets were so good, and that's what really helped holiday. That was the key to holiday spending.
Well, indeed, if you take a look at this chart we've got here, the S&P 500 Retail Index, that's an expression of capital and what capital believes in terms of value, because we've seen that increase in all of those retail stocks.
No question about it, something about 20%. That's been a fabulous area. The capital markets have driven spending. You look at luxury, that's all capital markets. You've got the bonuses on Wall Street and all the lawyers and accountants helping and everything else. So we've got...
So companies like Tiffany, companies like Coach?
Coach doing great, Tiffany's doing great, Saks, a lot of them doing very, very well in the luxury space. The big comebacks in jewelry, where we closed 1,300 jewelry stores, and now we're on a comeback trail.
How did that happen? I mean, is this something that we missed or just came about because there were more people that were willing to spend when they thought that they had a secure job?
When the government took over AIG, when we didn't have Bear Stearns, when we didn't have Lehman Brothers, when Citigroup's future was questionable, all the big banks, really there were so many layoffs, no more Merrill Lynch, Bank of America, all this happened. Suddenly, people stopped spending for good reason. They were over-leveraged. They were scared out of their wits. Capital market collapsed. That directly reflects itself in luxury spending. All that collapsed. Also, mid-level spending in department stores. Half of America is invested in the market, one indirectly or indirectly, so that we had a big change. Everything went in the tank. It's a little better now. But if you really look under the covers now, you have a lot of people with vested interests reporting on the sales. When you really look under the covers, Walmart does 10% of America retail sales. They have 150 million customers.
And Walmart stock has done basically nothing the whole year.
Walmart has been down 6 straight quarters. Sears is the largest department store in America. They're, terrible, and their stock is down for the year, even though the retail index is so good. So the largest department store and the largest retailer on the planet with 10% of U.S. retail sales is not good. Best Buy had a huge earnings miss. Toys R Us loss increased last quarter. A&P, a huge...
bankruptcy right now.
Just filed bankruptcy. Loman's just filed bankruptcy. Charming is going to close over 100 stores. If you look at what's going on, I mean, TJ Maxx just liquidated the A.J. Wright division.
So why are certain retail operations seemingly so sought after? For example, BJ's wholesale.
Right. Oh, there's going to be a lot of M&A activity. There's no doubt about that. And BJ's wholesale is doing well. They're generating tons of cash. The stores, to me, look very well merchandised. The only other independent company is Costco. You have Sam's Club, but that's Walmart. You got 3 companies in this business. It's really a great business, the wholesale club business. So that BJ's will be a sought-after company, generates tons of cash. I think a deal will be concluded sooner rather than later on that.
Howard, we were talking during the break about how easy it is to mess up a business because we started talking about Sears Holdings and about Walmart, and then that rapidly shifts into a conversation about what's going on online, Amazon.com. What happened to Sears, and how come Sears did not become the Amazon.com? Because it seems as though if you think back long enough, they had the Sears catalog.
You know, Pimm, we got two stories here. We got A&P, who was the largest food retailer in America, and who was so dominant in food that the government slowed down their growth. That's how powerful they were. And then we had Sears, who started buying all these brands, and the government was petrified. They slowed them down because they were so powerful they were going to dominate all the retail. One is broke and one is in the crapper. It is very easy. It is a management-intensive business. A few mistakes put you right off the track. This is a very tough business. It's very people-intensive. You know,
So does Eddie Lampert not have the people to execute a strategy at Sears, or is it just too late?
Well, Eddie Lampert came in, and he decided, number one, he was not going to be competitive on price, and he still isn't. Number two, he's not going to put any money into the stores. He's going to sell the best stores, which he did to Home Depot, which was very strange. He got a lot of money. He paid down debt. And he bought back a ton of stock.
Locations.
Yeah, he sold some of the best ones to Home Depot. That was a little weird. And then all the stores ran down. The prices weren't competitive. And his comp store sales are down forever, and he's sitting there. He is investing in online retailing, but that's not working out so well. So nothing, you know, he's a hedge fund manager. He's blocking and tackling by the numbers. He's not a retailer. He never brought anyone in to run the business who's a merchant. So this is where he is. He's in the tank.
All right, so contrast that. You said we've got two good stories with Amazon.com. Particularly not only with their ability to offer shipping for one price for the entire year, but also they're now in the product business, the Kindle.
This is a giant. This is going to, I think Walmart is scared stiff. I think, you know, when you look at a company is generating giant numbers, this Amazon we're only at the beginning of this online sales, and that has to lead you to a question of the whole retail real estate strategy. We've got 21 square feet of selling space for every man, woman, and child in this country. With the explosion, we already have double what we need. With the explosion of online sales, what happens to all these retail malls and tons of shopping centers that are marginal? I think there are huge questions going forward about size of stores, locations of stores, distribution facilities. Huge changes are going to be taking place in the next 5 years as people continue to shop online.
Well, we haven't even brought in the notion of mobile shopping, which allows you to price compare as you go into a store, which affects the bricks and mortar operation even more.
Absolutely. That's minuscule now, but will become more and more important as we go forward. Best Buy has some very exciting applications on that because they not only show you the pricing in their store, but other competitive stuff. Really, it's fantastic. But a lot will go on in that area. And
so does the consumer win? I mean, who wins and who loses out of all this?
Well, I think the consumer wins. I think if you're a department store, that's your fastest growing area, online sales. But in the end, what do you do with the retail space? This is going to be a huge question for retailing in the next 10 years. That's why Walmart is starting to build smaller stores. That's why Walmart is building more overseas than they're building here. There are major questions of positioning. Going forward, it's going to be the biggest retail change we've ever seen.
So what are commercial real estate landlords going to do? Are they going to have to get ahead of this by trying to figure out other uses for those spaces? Are they all going to be restaurants?
Well, they better start figuring it out pretty quick, in my view, because they already have occupancy problems, rent problems, and everything else right now. I don't think the commercial real estate problems are fixed by any means. That's why we're going to close hundreds of community banks going forward. We just closed a record amount. We'll close hundreds more.
Because the commercial real estate debacle will continue.
It's going to continue. Those debts are coming due.
And they won't be able to be rolled over.
They will not be able to be rolled over. We got lots of problems still coming up in the banking system and every else we're doing. there are some problems. The real estate issue is here for a long time.
So what about the online retailers that also have a physical presence? If you mentioned a department store, they also have branches of other brand name goods inside their stores. Polo, Ralph Lauren, for example, inside of Bloomingdale's and Macy's.
I think they're all looking for ways to capitalize, and wisely so, on the online trends. It's their fastest growing area. What they're not looking at is what to do with the excess space they're going to have in their stores. Department stores are not growing. We're not building any malls. Zero. There's starting to be a recognition we have a problem with this explosion in online. You can't just keep building more physical space. So there's going to be a huge revolution in size of stores, locations of stores, and what you do with existing stores, what developers are going to do. They're not doing anything about this. They're sitting there praying it goes away. It's not going to go away. So this has to be dealt with.
Are you surprised by the strength of retail sales in this year?
I'm really not, because once I saw that the markets were doing well, I knew that about 30% of the consumers in America are responsible for these sales.
30% responsible for the majority of the sales, the whole sales.
The whole thing. Because 46 million people are on food stamps. They're all shopping at Dollar General, Dollar Tree, and all those stores, which are doing great. But that about 30% of America did much better because of the performance of capital markets. And I knew there was going to be a comeback. I don't think it's indicative of anything going forward.
You don't think the economy is going to get much better in 2011?
No, I don't. Because I think if you look at our fiscal and monetary policy, we went $2 trillion in the hole last year. $2 trillion. $2 trillion to produce this. And unemployment went up to 9.8. We spent $2 trillion. We're printing money. We're going bananas. Our balance sheet, we got $2.6 trillion on there. And what's on there, the government securities and these mortgages. This Bernanke is sitting there. I mean, if interest rates go up a point, he's bankrupt. I mean, everything he bought is going to be underwater. All his mortgage-based securities are underwater. The whole country's underwater.
Well, I hope you're going to help us. I hope you're going to help us swim. At least we'll be able to swim to you for some guidance. I want to thank you very much. Howard Davidowitz coming to us as the chairman of Davidowitz Associates, shedding some light on the economy and the retail world. Thanks very much.
And thanks for the invitation.
Always good to have you.